And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show. And this is the show where we bring you where the action is in the broader markets. So welcome to Friday the 13th. Let's go ahead and take a look at what we are going to be reviewing here today. As usual, we're going to take a look at the current markets. Just a reminder, I am recording this show we do still have an hour into the close of the markets, so not quite sure where we will close the day, but certainly we can get a good feel for what has occurred this week. And also we are going to take a look at some of those top headline news items that drove the markets. It's been certainly quite volatile. We were down quite a bit going into today. We'll take a look at some of the news that drove the markets down this week. And then Fed talk and high inflation. We're going to take a look at that, the impact and what is going on in that arena. And then building your watch list. And this is something that I have been doing for the last several weeks here. And I'll share with you some of the tips because you want to be certainly prepared when the markets turn so that you can take advantage of any upside price action that is poised to continue beyond just a day or two. So here we are with last week's price action. We did get two separate, very important inflationary numbers that came out. Core price inflation, better known as the CPI. This is a metric that the Federal Reserve pays close attention to. So likewise, you do as well want to be on top of that. And we did see that the overall core inflation number did decline just a bit. However, when you took out the food and energy prices that have been escalating and looked just at that core inflationary number, it did come in higher than expected. We did see the market sell off on that news. Higher inflation means a more aggressive Federal Reserve as it relates to raising interest rates, and that is not good, certainly for certain areas. We did see the US dollar continue to rise. We'll talk about that and the impact, and also interest rates did pull back a bit. They had gotten up above, I'm looking at the 10-year yield on that treasury, and we did get up above 3% last week. And this week we pulled back from that rate. Also, oil prices, they do remain elevated. I believe we currently at this time we're at about the 107 per barrel price. So anything above that $100 value is viewed as elevated. And then we did see consumer sentiment for the month of May. It did fall as consumers are really being more and more aware of those high inflationary pressures. Next week, we're going to see retail sales numbers come out, industrial production, and then housing data will be reported. So from here, let's go ahead, take a look at the broader markets and see not where we closed, we're not quite there yet, but certainly see where we currently stand as it relates to the broader markets. So we can see on this daily price chart of the S&P 500, we did get into very close into an oversold position on this RSI. It's something I talked about in my MEM Edge report. I certainly was anticipating a relief rally at some point in time. And today, in fact, we did get that. It will be very interesting to see how we go into the close if we're able to contain or retain the gains that were in place, certainly for most of the day. From here, let's take a look at the stochastics. This is a faster moving momentum indicator. And during bullish periods, or certainly constructive periods, the stochastics, you want them to be up above this 50 level and trending higher. So we did have this rally here, certainly in the beginning of March, where we experienced the stochastics heading higher above this net neutral 50 and then trading above these moving averages. Unfortunately, it did not stick, but that's what we are on the lookout for. We can go back to generally upward trending periods back here last summer into the fall, and you can see generally during those periods, your stochastics are heading higher and above 50. So currently we are now down in this oversold area and trending upward a lot remains to be seen here. We are closing the week below this 4115 level. That was the low on February 25th, and we had been retaining that just ever so slightly. And then this week's deterioration, we are poised certainly to close below that particular area of support. If you haven't already, go ahead and use that button below. Trial my MEM Edge report twice weekly. We've targeted the next area of possible support. You'll want to be aware of that. As far as this weekend, I will be drilling down quite a bit more and analyzing next steps for subscribers. So please take a look there. But from here, let's go ahead and move forward, because I do want to share with you what is taking place within or behind the broader markets. We want to see the price action in the 11 sectors here in the S&P 500. They're listed. I've added this RSI indicator and sorted it in descending. We want to see where the relative strength is taking place relative to weakness. I'm going to go ahead and update this as we head into the close for the markets. And here we are, energy up here in the forefront. Overall, as a sector, it is at this juncture performing in line with the broader markets, down 3%. Energy is down 3%, but take a look. Nice rally here today. This is the only area in my MEM Edge report where I do have stocks selected as a buy. Otherwise, it is all about bolstering and building that watch list. And we did get dips here on energy below the 50, but this is a group that can sustain that. You want, when you're looking to potentially put money to work in an otherwise treacherous market, go ahead back historically, take a look at that group. We had a wobbly period certainly here where energy stocks did dip below that 50, but were able to recover. So, and likewise here in this late February period. So we did stick with our names, recommended them as a strong buy at the end of last week. And indeed, we are seeing very nice traction there. Let's go back to some of these other sectors, take a look at where we stand. Consumer staples, XLP, and utilities, as well as healthcare, up in the forefront. This is all about areas of the market that are defensive. And then also they offer a high yield, and that is very, very constructive during periods of high inflation, as well as higher interest rates. One other factor here with these staples, utilities, and healthcare stocks, each of these areas have been able to, within the underlying companies or stocks within those groups, they have had the ability to raise their prices. With staples, it's all about brand loyalty. Utilities, consumers, not a lot we can do, but they have been raising utility fees to their customers. And then healthcare, I've been listening in Pfizer and a number of the larger pharmas in their earnings calls, their quarterly reports, and management is raising prices there. Certainly, as a consumer, if there is medication needed for diabetes or any other serious illness, unfortunately, not a lot we can do as far as pushing back, but that is another key factor and reason that these areas are up here in the forefront. Now, of course, today's rally, we are seeing a lot in the way of what I can only term bottom fishing. Let's take a look here at technology. The group's on track to drop about 4% for the week, but certainly if you compare that to where the technology sector was midweek, we are certainly in better standing. It was down over 6%. So take a look here. We can see that tech, for instance, it has been hardest hit here of late. It really got oversold. It's difficult to see down here, but we can see just how low it did get into Thursday. We did see buying into the close that has carried through into today. We're up 3%, but the overall group is still down quite a bit. So again, today's rally, a lot in the way of searching for those super down and out names. And I'm sure we will be reading about short covering being a component of today's rally, as well as the bearishness among investors, economists, and so forth really reached what I can only call a fever pitch. But let's go ahead here and take a look at some areas that are not bouncing with today's rally, certainly not as vigorously as elsewhere. This is the real estate sector, XLRE REIT stocks. And with my MEM Edge report, we did have stocks that we were in on this particular rally here, but once we began to break key support, uh, it was very reminiscent of this peak here and deterioration when we got this MACD crossover, indicating that this uptrend had shifted. We did get out of those real estate stocks, and a lot of this has to do with a rising interest rate environment. These REIT stocks, they do provide growth by increasing their portfolio, purchasing additional buildings. Higher rates make that more difficult. And then even more important, as these companies came out with their Q4 earnings, or in this case, funds from operations, they were guiding lower going into the rest of the year. And I'm not saying every single one, but certainly well-known names. It was enough to really take the shine off of that particular industry group. So from here, let's take things a bit further and even look further into the broader markets. I do have a number of ETFs that we are looking at this 2-month daily price chart view. And as we go through, you will see the relevance here, because I talked about the US dollar continuing to rise. Take a look now. We are up here. This is UUP, one of the many ways that you can track the US dollar. I'm going to go ahead and put a longer term view here, and you'll see quite clearly the really significant rise. This is a weekly price chart that we have seen here in the US dollar of late. The impact here is there's a lot of relevance here as it relates to a rising dollar. We will get into that. But one area, or one reason next up here, let's take a look at the yield on that 10-year treasury. And we can see that it is pulling back a bit. We did get up to that almost 3.2 level. And these rising rates make the US Treasury bonds, in this case the 10-year, attractive to foreign investors, because there's not a whole lot up here yielding quite that much. And as such, that does boost the dollar further. And we'll go ahead and take a look at some of the areas here that have been impacted. First up, we can take a quick look here at gold. GLD is the ETF I'm using here. And rising dollars do tend to have a negative impact on commodity stocks, and certainly gold is very evident of that. Another factor here with gold is that rising interest rates, gold is not attractive. It is a non-yielding commodity, of course, so it loses its luster. So let's go ahead and move on a little bit further from here, because I want to take a look at this volatility index. And despite what we have seen, we have seen certainly a lot in the way of daily volatility. We did get up this week as high as 35, almost into 36, which is certainly elevated. The average for the volatility index going back historically is anywhere in that 18 to 20 range. That's telling you that there is investor confidence, stability in the markets, and we are well above that. However, today we are pulling back below that 30 level. So keeping an eye on volatility as this VIX, better known as the fear index, continues to rise. In turn, that is a negative. Generally, in that environment, the markets are deteriorating. So further moving along, I'm going to share with you two of the areas that have had the most significant turnaround, certainly from Wednesday to Friday. Does not mean they're out of the woods, but again, big rally. Here we are with the semiconductor index. It's up 5.5% today, and semiconductors were down about 5.8% on Wednesday, and at this point they are poised to close the week up about 1.3. But no doubt we are still in a downtrend. Not anything from my work to get overly excited about, but just pointing out to you where we are seeing that biggest turnaround impact with today's rally. Here's biotech's IBB is the ticker symbol, super down and out. This is another area that going into midweek was down about 6%. We are poised to trade up or close the week up just about a 0.5%. But really what you can see in essence, as it relates to those areas that are seeing the most in the way of buying power today are those down and out. And I'll share you one way that you can very quickly assess that. And in addition to taking a look at these various 2-month daily price charts. So from here, we're going to take a very brief break, and we have lots more. And we are back taking a look here at this initial interface page on StockCharts.com. I'm going to share with you 2 quick ways to assess what is on the move on days such as today. Certainly we can see with that sector summary here with consumer discretionary, one need only look at a couple of names that we will look at that will share with you what in particular areas are working there, and energy and technology, but certainly discretionary technology, communication services. These are your most down and out areas, and they're seeing the most in the way of buying. So from here, let's take a quick look at the S&P 500 as a for instance. These are the names that today are up the most. I'm going to pull up a candle glance 2-month daily price chart view, and quite simply you can see NVIDIA, this is Caesars, SEDG. I'm not quite sure what that name. Okay, yes, it is a tech stock, but by and large, it is these very down and out. This is a cruise ship stock and semiconductor and so forth. So as far as the names that are seeing the most in the way of a bounce, down and out. From here, let's go ahead and take a look at another very quick way that you can see what is on the move. So this is a new feature with StockCharts.com where you can populate a list with the S&P 500, the NASDAQ. So let's go ahead to the NASDAQ. We want to take a look at those as the components within the NASDAQ 100. You can view this list any number of ways, but I'm quite simply going to ask for that summary view. And very quickly, out of those 100 names, these are the names that are up the most. We're seeing double digits, even 3 times what the broader NASDAQ is doing. But let's take a look at this StockCharts technical rating. As many of you may know, the higher the number, the better. And by better, I mean the price chart is more constructive. It's not super down and out. And take a look. These biggest winners have single digit. Let's just take a quick look at DocuSign as an example. This is the name second highest up on that NASDAQ 100, but what a down and out chart. So again, whether it is short covering, whether you need to label it or not, really what's taking place is these biggest gainers are those that have been beaten down the most. You'll see a name or two here, but even looking at MU, that is not an attractive chart. So I did want to share that with you as yet another way that you can very quickly assess what is really on the move on any given day in the broader market. So from here, I did want to go ahead and share with you a couple of other ways to very quickly get your arms around what may be taking place. So we're looking at the Dow, and I did want to share with you, these are the components within the Dow Jones, so 30 stocks. And what I've done is added that RSI. So let's take a look at what is holding up well in the Dow. We talked about that bottom fishing taking place. It's also certainly taking place here in the Dow, but I did want to share with you of the 4 major indexes, certainly that I cover, the Dow is down about 13% from its peak, and that's relative to the NASDAQ, down about 27%, even with today's rally. Small caps down 27% as well, and so forth. So the Dow on a relative basis is holding in the best. So from here, let's just take a look at why the Dow is in essence relatively outperforming. So up here in the forefront are your top performers, and we can see it's all about healthcare, Merck, Coca-Cola. These are consumer staples, and then energy stocks. The Dow does have several energy names in here. I'm going to share with you a look here. I've written about IBM several times for StockCharts.com, and we can see it had this big gap up in earnings, pulled back, and is conceivably coming back into positive territory here. Despite being a tech name, the stock offers a very high yield. Let's go down to this full quote here. I'll update the chart, and you will see it has a 4.9% yield, which is one of the highest among those dividend aristocrat stocks. So in addition to having growth prospects that are constructive for this year, they're offering that high yield, which makes it attractive as well. So again, you can see up here in the forefront, we do have, it's either healthcare or otherwise consumer staples. And then as we drill down to these weaker names, Nike, for instance, is outperforming today. Apple, let's just take a quick look because I will do that in the next segment. From here, I want to share with you a view of those FANG stocks, those mega cap, Facebook, Amazon, Apple, Netflix, and so on. These are the names that we need to come back into their own so that we can get that NASDAQ really up off the ground. And we can see by and large that the FANG stocks are continuing to struggle. They're down here. They're not up a lot today relative to certainly other stocks. Netflix down here on the floor trying to get up, Amazon as well. But I did want to share with you Apple's stock because there was a significant move this week, certainly for those that follow the stock closely. Actually, let me get out of here. I'm going to pull up a longer term view chart to really capture what took place this week. So from here, annotate the stock, and wanted to share with you that this Apple does and did have an area of support that really held for quite some time, in the sense that any rally to that area, buyers came in. This is certainly the recent sell-off that we've seen, and it is that 150 level where the stock found support. And we can see this week it has broken that area. And it was not until today that buyers came in. It is up 3.5%, but not a big, strong rally. So that was certainly one item I wanted to share with you. And then from here, we can just take a quick look at some of those down and out names. If you have not been paying super close attention, some people are just turning their screens off during this period. But this is Amazon, the gap down, not only on weak earnings, but they guide it lower going forward. And it really did get hit quite hard. It is rallying more than the markets, but I would argue, take a look. This is an oversold position. From that oversold position, you are going to be on the lookout for a rally. And we did get that back here at the end of January when the stock was oversold. So we'll see if it's able to pick itself up a little bit further from here. But by and large, certainly a down and out, not attractive looking chart. So I did want to, from here, share with you. Let's just take a quick look. Now that is certainly Brent crude. We talked about that remaining at an elevated level. I think we have a few minutes left here, and I can share with you this concept of building your watch list. And ideally, what you're on the lookout for are companies that have reported. We are in the ending stages of the Q4 earnings season. So we've had enough information as it relates to companies that have reported strong numbers. And then you want to take a look and see subsequent to that, have they relatively outperformed the market? So I'm just going to share with you a couple of examples here to potentially get you started, if you will. And a lot of the names I'm sharing with you are not typical leadership stocks simply because technology is still down and out. We're seeing NVIDIA and names such as that rally today, but they don't have constructive charts. So let's take a look at Mattel as a, for instance, MAT is the ticker symbol. Here's your gap up at the end of April on earnings. Take a look at that huge volume, buyers coming in spades. The company not only had strong earnings, but they also guided higher going into their estimates for this year. There was another piece of news that came out on the release of their earnings that management did not talk about, but other the Wall Street Journal, for instance, did mention that Mattel is potentially in the throes of going private. And that is akin to being bought out in the sense that it can be really constructive. So the stock rallied to new highs in an otherwise difficult environment. It did succumb to those market pressures, pulled back, found support at this 21-day moving average. And throughout that pullback period, the RSI remained positive. So today it is rallying a bit higher than the broader markets. So we'll see where we end, but you can see I'm on the lookout for those stocks that have reported strong earnings, management has guided higher, and it has a constructive chart. Let's take a look at another area. This is not so much earnings related, but we are looking at CF Industries, and this is one of several agricultural fertilizer stocks that really rallied certainly when Russia's invasion of Ukraine first came to light. We did see a very sharp rally here. Ukraine is a huge exporter of grains and other uh, commodity products, so that the need for fertilizers, certainly in other countries, really exploded. So we can see that the stock had a very significant advance February into April. It did pull back very orderly. And then with today's rally, we are back above these shorter term moving averages. We're getting pretty decent volume. I'm going to want to see that black line up through the red. This is in an area where there are pockets of relative strength in an otherwise difficult market environment. These are the kinds of names, depending on the story, if you will, that you could conceivably put money to work if you are nimble. Here's another name, ZIM Integrated, and it is a shipping stock. They are due to report their earnings next week. That's something of note. But I went ahead and added that full quote because I want to share with you. I'm not quite sure what to make of it, but there it does show a 30% yield, annual dividend here, very, very super high. But shipping stocks had a huge run up going into this March period. They have been able to raise their container fees super high without pushback, but they did fall in line with the broader markets, conceivably coming back into positive territory here ahead of earnings. So can certainly keep that one on your list. And then a couple of smaller stocks that we can take a very quick look at here. Um, we can see this is SMCI. Take a look. This was a huge gap up. I believe the stock gained about 30%, super strong numbers. But we can see the stock has a history of these gaps up pullbacks. So we can see it pulled back to this upward trending 10-day simple moving average. And we do still have that full quote. So we can see it's about a $2.3 billion company. So a little bit smaller, not the normal in any way leadership type stock that I'm on the lookout for, but this is more what you are going to be on the lookout for as it relates to those the constructive chart patterns. We can take a look at one other name that gapped up here on earnings and is conceivably yeah, again, not your best looking chart, but this is Credit Acceptance Corp, CACC. This big move here, strong earnings, pulled back, and poised to trade back up above that 200-day. I'm going to leave it at that. Again, go ahead and use that link below. You can trial my MEM Edge report. I will keep you totally on top of these markets, and have a great week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.